Good morning, everyone, and welcome to Trading with Larry. I am Clint Brewer, Larry's research analyst, and as you can see, I am flying solo today. No Larry, no Eric, they are off today, but we still want to get you ready for the trading day ahead, talk about some of the really big narratives and themes that are driving the markets. And it's been a little while since I've been on. I was on vacation last week. I'm back in the office, and there's a lot of things that have been happening. And this is going to be a great opportunity for me to update some of the charts, the themes, the things that I've been watching that are really starting to evolve right now and how they're impacting the market. And so I get to bring you all those updates today. But before we get started, there's a couple things that I want to ask of you. One is I want to make this as interactive as possible. So if you could, please submit some questions. Again, I'll try to get to every question as possible. So if you have questions, if you have something with the macro backdrop that you're not sure how that's impacting the market, if you have a chart we want to look at, submit your questions, and I will try to get to all those as much as possible. And the other thing I want to ask you to do is to please hit that like and subscribe button. The one I want you to really go for is the likes. And here's my challenge, all right? I'm doing this solo today. Next week, when Larry and Eric come back into the office, I want my video to have more likes than anything they've ever done, okay? Because, there's one thing that Larry hates is not being able to have the last word, okay? So if I can come in next week and point out to Larry that my video has more likes than anything he's done recently, that'll get him fired up before the show even starts. So hit that like button for me. All right, let's get on to some of the things we want to cover today, some of the topics. And, we've been trying to structure the show, the podcast, under a new format. And today, what we would normally be bringing to you is what we would call trend watching. But I'm not going to call it trend watching. I'm going to call it narrative watching. There's a couple really big narratives that are impacting the market right now. One had kind of gone away. Now it's coming back, and the other is starting to evolve again. Kind of reminds me of what was happening earlier in the year. And so let's start with the AI spending narrative, because the big news that we've had overnight is that you've got Tesla earnings came out, Alphabet earnings came out, it's Google parent Alphabet, and the reaction is very decisively negative to those earnings reports. Google down, or Alphabet down about 4.5% to 5% pre-market. Tesla, last time I checked in on Tesla, was down about 7 or 8%. And so that, of course, is weighing. Those are some really big names that's weighing on the rest of the market. You've got S&P 500 and NASDAQ futures are sharply lower here as well. And so what's driving the reaction? You kind of got, we're used to these companies coming out and just smashing expectations on both the top line and the bottom line. I know look like revenues beat on for both companies, but it's this fear around the concerns around how much is being spent on the AI infrastructure build out, especially by hyperscalers like Alphabet. And I have a chart I'll show in a moment that really sums this up in a nutshell. But Alphabet came out. They're guiding to the high end of their CapEx, or they upped their CapEx range again. They said they could spend up to $205 billion. Elon Musk, during Tesla's either their press release or their call, I noted a quote from him basically saying we're spending as fast as we can. And this is a narrative that emerged very early in the year, to where I think it was after the fourth quarter earnings reports, as those were rolling out, that you saw stocks really starting to get punished because of these higher CapEx guides. And that was a big change, because there was heading into that, really, this cyclical bull market that started in late 2022 emerged alongside ChatGPT. So AI has really been, and excitement around AI has really been a foundation for these gains, which has been reflected in names like NVIDIA and AI hyperscalers and so on. And initially, for a long time, there's a lot of enthusiasm around the money being spent, to support that build out, how much money is being plowed into data centers and how that trickles through to the rest of the AI ecosystem. That started to change earlier this year. Now all of a sudden, the amounts being spent is being called into question. You saw, instead of stock prices being rewarded, stock prices are being punished. And now we're seeing that again, at least this morning. And I've got one chart I'll share really quick that really highlights, why is this narrative coming back into the market? Why are investors now punishing these companies? Because these AI hyperscalers, these guys used to be cash flow machines. These are just absolute cash flow cows. And that is completely reversing course. I think collectively, you look across the major hyperscalers, free cash flow is dipping into negative territory this year. And I'll share this chart. This is just for Alphabet. So this is quarterly free cash flow, and it's basically taking high level, taking your cash flow from operations and netting out CapEx spending. And so it's that big CapEx spend, that ever increasing CapEx spend, that is driving this figure now into negative territory. This goes back over 20 years. All right, this goes back to the start of 2004. And you can see there's never been a negative free cash flow quarter for Alphabet until now. So you saw the big drop off in the first quarter and now further into negative territory. And this is really setting the tone for, or setting the stage for, other companies that are going to be coming out and reporting soon. So this early first round came out, and this was from Google, from Alphabet, and from Tesla. So we'll keep an eye on those things. But that's so. What we want to look at then is how that is impacting, some trades that we want to be following. And I guess that's where I can start today is this pullback that you've had in, especially in AI linked names, and how that's flowing through to some of the ETF and indexes that are really heavy in that exposure. And there's two that really come to mind. One where, definitely you're going to see an impact from Alphabet and Tesla this morning is with the Qs. So the Qs track the NASDAQ 100, and I'm going to get a chart pulled up here really quick. I just finished helping Larry write this up for his e-letter, Trading with Larry, which is completely free to subscribe to. You can get his e-letter into your inbox. I believe it's 5 days a week. And one of the things that I wrote about a month ago that I updated just today is this setup that we have in the Qs. It's a very much it's kind of a textbook technical pattern that's unfolding right now. Could lead to an actionable trade setup, especially with what we're seeing and happening with Alphabet and Tesla this morning, and how that's weighing on the NASDAQ. So let me share my chart here really quick, and I'll show you exactly what I'm watching, so you can look at this yourself for a potential trade if you want to look at something relatively short term here. But here's the chart of QQQ. Again, this tracks the NASDAQ 100 ETF. You can see right now this is a little bit delayed on the pre-market, but down over 1% on, following that price reaction from Tesla and Alphabet. So no, given those weight of those stocks in this ETF, no surprise there. Again, this in the Qs, the top 10 stocks are in some way, shape, or form all leveraged to the AI trade. And those top 10 stocks make up over 50% of this thing. So, this is the Qs have become a proxy for the AI trade to an extent. But here's what we're watching. So a couple things to note in this chart. I got trend lines drawn on here showing a triangle continuation pattern that had been forming since the start of June. This is where this big rally off the late March lows kind of topped out for the Qs, for the S&P 500 as well. And we've just been grinding sideways in this narrowing range. There's a couple things I would note as we were trading in that range. One, you kept coming down, finding support around the 50-day. This is the blue line on here. So that was a good support level to trade off of for a while. The other thing that was happening that we noted in our first write-up of the Qs a month ago was when you came back toward these prior highs, you had a much lower high in the RSI. So this in and of itself is not a signal to trade, but that tells you that upside momentum was fading. You can use this the other way around as well. If you were making a a lower low in price, but the RSI is holding up, that's a good thing. That shows momentum's building, or at least momentum's fading from the downside move. This showed momentum really starting to fade from in this upside move in the Qs, and that gave way to a couple tests of this 50-day, which then over the last week or so, you're seeing that give way. So two really big levels here that we lost on the downside. One was the 50-day, the blue line, but then you can see we fell out of this triangle pattern. Now, here's where the next setup comes into play. A lot of times what happens when you lose a key level like this, you will come back up to test that level. So, and there's really two levels in play here. I mean, not only did we lose trendline support, we lost the 50-day. So in either one of those patterns, again, it's common to see price come back and test before rolling back over. And so that's what makes the last couple sessions interesting. You can see the gains we had over the last two or three sessions. If I were to extend this, brings us back to that trend line. So we're getting that trend line test from below. Again, that's a very common thing to happen when you get these breaks. And so, if one trade that you could potentially look at to, that you could skew risk return in your favor is to add some sort of a short or put exposure to the Qs, and your stop just becomes if price rises back above this trend line or back above the 50-day. So that's a way to keep a stop relatively tight while positioning for a continuation move lower out of this triangle. So that's something to keep an eye on with the Qs very near term. The other trade I would keep an eye on is what's happening specifically with semiconductors. I mean, chip stocks, Larry talks about Micron all the time, but I mean, if you look across the entire sector, chip stocks had a massive run, from basically early April up until about the end of June. And we've seen a big mean reversion the other way. Eric will talk about factor exposures. Well, the semiconductor trade basically became synonymous with the momentum factor. You had a big win in the momentum factor. Now there's been a very massive unwind in that factor to the extent that, some of these names are being pushed into bear market territory. You've got a lot of semiconductor names that, from their peaks in June to some of the recent lows are now down over 20%. So that's something to keep an eye on, is how that trade continues to evolve and potentially unravel. And there's some levels to watch there as well. And I'll flip over to that chart really quick. But to segue into the next narrative that I want to talk about, it's linked to what you're seeing in the Qs. It's linked to what you're seeing with the semiconductor trade. And it is that, while earnings are going to receive the blame for the move we're getting today, the other thing that's been happening has been on the interest rate side of things. This is, in my opinion, this is probably the biggest catalyst, biggest headwind facing the market right now, especially in the growth side, where there's a lot of earnings enthusiasm, but valuations are being pushed higher as well, and valuations are susceptible to rising interest rates. And there's not been a lot of attention, on this area lately. I know Larry's been talking about it more and more recently. This has been one of the only places where I've seen, coverage of interest rates. And I want to get to that more in just a minute, because I think that's another big kind of hidden catalyst behind what you're seeing with the tech and semiconductor trade right now. But before I do, I want to highlight those levels really quick on chip stocks. And so I'm going to bring up another chart here in just a second. And this is going to be the VanEck Semiconductor ETF, ticker SMH. And there's a couple levels that I want to keep an eye on with this trade right here. This is, if you're in these names, if you've been in these names and you've got a big win, it's always smart to take gains along the way. If you haven't been in and you're wondering if there's more downside, or if there's an opportunity to trade it alongside short term, there's some levels that I would keep an eye on the chart. And so this is the SMH ETF that I will pull up right now. And there's a kind of a two things I want to highlight. One is that you have a similar test underway is what we're seeing with the Qs. It's the trend lines. Drawing trend lines on SMH is less clear than what it was with the Qs. But you had this loss of the 50-day, the blue line on here. Now we're coming right back. We tested it from below. And now we're down. 1.7% pre-market. So this is an area that if you're looking to get short semiconductors, if you think the trade is still to fade that big rally until late June, and you want to take a stab at shorting these names, this is probably a good area to do so, because you could place your stop just above the blue line, just above the 50-day. That's a way to kind of try to keep risk under control, looking at an area to where you would get out. The bigger pattern I would watch on here is it's not symmetrical to say, but you almost have this head and shoulders pattern forming, to where you had a I don't know if you want to call either of these two highs right here, the shoulders on the left side. Now maybe we're forming a shoulder on the right side. And so if we are, then the head's in the middle. Now, if we are, this becomes the big level to watch. Is this, I would watch these intraday lows. This was from July 17th, and then again on May 19th, touching a similar level. So right around this 530 to 535 area on SMH. If that gives way, there is a lot more pain in store for this trade, in my opinion. And really, what very short term, if you were trying to look to short this name from this level, that from this test of the 50-day, that becomes my initial target. My initial target becomes this 535 area. So that's something that you could look at for a very short term trade on SMH. From there, bigger picture, this 530 to 535 level, this becomes really important to SMH and for the semiconductor trade in general. If that gives way, then I'd say there's definitely more pain in store there as well. And so we have today's catalysts that are driving that trade. Again, we recapped what's happening with Tesla, what's happening with Alphabet, and how it's weighing on the indexes. But that's just the latest part of this narrative that is coming into view. There's been something more important, in my opinion, that's been evolving under the hood, and Larry's touched on this from time to time. And that's been with the rate outlook, and something I think very important happened after the latest CPI report. The latest CPI report was out last week. It was softer than expected. I think it was like a 0.4% month-on-month decline. It was one of the biggest declines in the last 5 or 6 years. The headline figure was something like 3.5%. But it was a softer than expected figure all around, which really seemed to set the stage for, or at least would start to lend some support to Trump's demands, not to necessarily cut rates, but maybe it eases pressure on the Fed to not have to hike rates as quickly. So Kevin Warsh, the new Fed chair, his first Fed meeting, he was, we got another Fed meeting coming up, but his first meeting, he surprised by being more hawkish than expected. So that was a very notable development with Warsh. And so that softer inflation report, that softer CPI report, maybe gave him some cover to back off the hawkishness, for the expectations for rate hikes to ease. But it has not done that. If anything, it's been the opposite of that. And that might go back to what you're seeing with oil prices. I know we had we'll look at some questions really quick here coming across in the chat, because I know we had a question about oil prices. But someone commented about oil moving high and having to raise rates. Well, let me show you something I'm watching that's related to that. This is going to seem insignificant. This is going to seem not consequential. This, in my opinion, is the most important chart for the market right now, especially with what it's doing just recently. And I'm going to pull it up here really quick. This is the 2-year Treasury yield. All right, so I'm sharing a chart of the 2-year Treasury yield. Why do I think this is so important? It's because the 2-year yield, I've shared this before when I've been on the podcast, the 2-year yield tends to lead changes in the Fed funds rate, okay? The 2-year yield is currently at 4.3%. And you can see, you talk about simple trend following. This is an uptrend, higher lows and higher highs along the way. Just over the last week, despite that softer than expected CPI report, the 2-year Treasury yield is making a higher high out to a new high. To me, that's a very significant move and signal from the market, that it's solidifying the outlook for rate hikes. Not that the Fed can be on hold, or maybe they've got some cover from that softer CPI report. This is screaming rate hikes, because right now Fed funds, the upper range of Fed funds is, I think it's 3.5 to let me look at my chart real quick. It is 3.5 to 3.75%. All right, so the upper range of the current Fed funds target is down here. All right, so the 2-year yield is way above where Fed funds is currently at. And again, the 2-year yield, if I overlaid Fed funds on here, you would see the 2-year yield has an excellent track record at changing direction before the Fed ever does anything. This is use this as a guide. I mean, this guides you as to where the Fed funds rate could be going. Now, it's not a precision tool. It could rise above Fed funds and stay there for months or a year before the Fed ever takes action. This is hinting at you what the market thinks the next move is going to be. And I think it's very significant that the 2-year, again, is making a new high for this move. That's a very, significant signal for monetary policy and what the market thinks that the Fed should be doing. And I looked at, odds this morning are also staying pretty hawkish for future meetings. Last time I looked at odds, let me pull up the probabilities really quick here. If you look up the CME's FedWatch tool, this is a great way to go out and track what the market is pricing. It uses Fed fund futures to come up with probabilities for where the market thinks Fed funds is going to be at. And while the Fed, it's actually odds for a rate hike at their meeting next week has been gaining. So it's at 38% now chance that they're going to hike, a 62% chance that they keep rates steady. All in the expectation is that they're going to hold rates steady next week. But then odds for a hike are greater than, way over 50%. It's about an 80% chance for a hike at the September meeting. And here's what's changed. Then again at the December meeting. So what's evolved over the last week is that the market went from pricing one hike this year and maybe one next year to now it's pricing 2 hikes before this year is even out. All right. So again, so take that in conjunction with what's happening with the 2-year, and you're seeing, a number of these ways to gauge what the market thinks for monetary policy is becoming more hawkish after what was supposed to have been a softer than expected CPI report. So don't lose sight of that. You're not going to see that discussed very much in, the mainstream financial media. No doubt, this is a major piece of major piece that's driving the market action right now. You're going to see a lot of headlines around Google. You're going to see a lot of headlines around Tesla, but keep an eye on the rate picture that's happening in the background. Again, Thursdays are, for the podcast, for Trading with Larry, is all about trend watching. This is a big trend. So, the two really big trends that we've covered so far today. One is the narrative and investor reaction to CapEx spending. You're seeing, at least early on with what's happened with Alphabet and with Tesla, that CapEx spending, ever increasing CapEx spending is being punished. So we've seen that shift from enthusiasm to now they're calling into question, is spending worth it? Especially that chart I showed earlier of what's happening with Alphabet's quarterly free cash flow, and companies now having to borrow and issue debt to try to make up the difference. So that's being called into question. The other big trend that you need to keep an eye on, especially heading into next week with the Fed, is what's happening with interest rates. So these are the two really big trends that I think are going to define the narrative, define market action, at least over the near term. We gave a couple actionable setups for you to watch, keep an eye on. With QQQ and the SMH, the semiconductor ETF as well. Sort of the back test of what was support is now resistance. So very short term. There's maybe a potential trade in there that you can look at. And then the other thing that I would highlight to you right now is what's happening with oil prices. I think oil prices are definitely a driver of what I was just sharing with interest rates. We've had a really big backup in oil prices. I looked this morning. I think WTI is back to trading above $90 per barrel. And so, that's going to stoke fears around the inflation outlook here once again. So yeah, that's probably a big driver of what you're seeing with rates. Something that was a big driver of the S&P's pullback into nearing correction territory into late March was the negative correlation it had to oil. So I saw charts back then. It's almost a near perfect negative correlation when you look at like a rolling 10-day return between the S&P and oil prices. So be aware of that correlation coming back into play into the market here. And that's if I look at things that I talked about, last time I was on the podcast, I know, one of the things I argued for was maybe not a permanently, but for the foreseeable future, a much higher geopolitical risk premium on oil prices. I thought it was absolutely absurd that oil prices had pulled back as much as they had. I thought that the risk premium baked into the per barrel price of oil needed to be a lot higher, given not only Trump's willingness to go after key producing countries, whether we saw it with Iran last year in the summer, if you remember that, we saw it with Venezuela, and now we've seen it with Iran this year. I don't understand why anyone would have been lulled into complacency around the lasting a lasting possibility of a ceasefire. We saw time and again that announcements of ceasefires or progress toward an agreement just completely unravel. We're seeing that happening again. So again, we've had the precedent for that. So again, oil prices were way too low. Have they overshot, and to where they need to be? Yeah, maybe, because we saw how quickly supply can come back to the market. So that's something to keep an eye on. But nonetheless, just watch that correlation for the oil trade on equities as well. I'm just going to glance back at the chat here really quick and see if we have anything else on here. I don't see any other questions coming through, so we'll start to wrap it up here. Again, I appreciate everyone watching today. Before you leave, please hit the like button. Please subscribe to the channel as well. It's Thursday, so we will be off tomorrow. Larry and Eric, I believe, should be back next week, and I will do my best to pop on from time to time as well. So we'll leave it there today. Good luck in the trading day ahead.